Hello and welcome to the weekly market metrics. I'm your host Sandeep Rao and we are in week 17 of 2026. Another eventful week. It began as many weeks do these days on the geopolitical front, with Donald Trump issuing an ultimatum to Iran warning of severe consequences if a peace deal wasn't reached by midweek. Strong words, sharp reactions, fairly characteristic of Trump. Back home, the spotlight was on the 2026 assembly elections spanning key states like West Bengal, Tamil Nadu, Kerala and Assam. The implications of it will likely and obviously play out over the coming months. On the global tech front, we saw leadership transitions making headlines. Tim Cook is reportedly stepping down from Apple and Reed Hastings has also announced his upcoming departure from Netflix, marking an end of an era for two iconic companies. At the same time, with 2026 shaping up to be an El Nino year, heat waves have intensified across the country. It's a reminder of the people working through extreme conditions every single day and also stray animals. If you are in any position to help, even in small ways, it's absolutely worth doing so. And finally, coming to the markets, after a positive streak over the past couple of weeks, we saw a pause this week. Nothing dramatic, but a reminder that markets don't move in straight lines. Also, do watch the sectoral update this week. We moved to tracking performance based on Tijori finance indexes, which are far more meaningful and granular than NSE sectoral indexes. Anyways, let's start with what happened last week and then we move to what to expect in the coming week. Starting with rate of change across indexes. After a positive close for 2 weeks in a row, all four indexes we track finished in red this week. SENSEX saw the steepest decline, losing 2.33%, while Nifty dropped 1.87%, BANKNIFTY was down 0.84%, and MIDCAP NIFTY showed the most resilience, slipping just about 0.77%. Despite this week's pullback, the month-to-date returns for April 2026 remains in the green across all four indexes. And it's worth noting that the YTD returns are still underwater across all four indexes. This could be a minor pullback within an ongoing up move, or the index might be heading lower after forming a higher low. We'll find out in the coming week based on how the price action plays out. Now let's look at Nifty on various time frames, starting with the weekly time frame. After two strong green weekly candles, Nifty lost 1.87% or 456 points this week to close at 23,898. The weekly range shrunk even further from last week's 845 points to 788 points this week. Friday saw the highest range on a daily basis. On the daily time frame, we saw two green days, Monday and Tuesday, followed by three consecutive red days, Wednesday, Thursday and Friday. While Monday and Tuesday started with a gap-up opening, the rest of the week saw the bears take control at the open. Wednesday, Thursday and Friday all opened with gap downs, with Thursday seeing the largest gap of the week at minus 0.72% or 176 points. Nifty is now trading below its key daily moving averages, including the 200 SMA as well as the 100, 50 and 21 EMAs. On the hourly time frame, the short-term long bias continued until Thursday. Since then, the bias turned short as the price is now trading below the 50 EMA. The question now is, will this short bias actually play out, or will the market just chop around after giving us such a clean trend? Let me know what you think in the comments. Talking about Nifty weekly expiry, which happened on Tuesday, 21st of April, the expiry had a range of 247 points and the opening ATM straddle premium was at 145 rupees. On the 5-minute time frame, the index consistently made higher highs and higher lows without giving any deep pullbacks. I would say it was one of the easiest expiries for short vol traders, both directional and non-directional alike. Moving on to Sensex on the weekly time frame, well, the candle has been unable to close above the 78,600 levels for 2 weeks in a row. For the week, it dropped 2.31% or 1,812 points to close at 76,681. The weekly range for Sensex came in at 2,963 points, which was slightly higher than last week's range of 2,862 points. On the daily time frame mirroring Nifty, we had 2 green days followed by 3 red days. As the week progressed, the daily close-to-close moves expanded, dropping minus 0.95% on Wednesday, minus 1.09% on Thursday, and minus 1.27% on Friday. Following these last 3 down days, Sensex, just like Nifty, is now trading below all important moving averages, including the 200 SMA as well as the 150 and 21 EMAs on the daily time frame. Now, talking about Sensex weekly expiry, which happened on Thursday, 23rd of April, well, the ATM straddle opened at 415 points, similar to previous weekly expiry. The actual range for the day was wider at 604 points, but trading 0DT was challenging due to multiple sharp pullbacks and recoveries. We saw a 350-point swing between 9:30 and 10 a.m., followed by another 370-point move from 12:30 to 1:30 p.m. All of this as the index continued to drift downward throughout the day. Except for a few who managed to enter early 9:20 style straddle, it was a tough Sensex expiry to navigate for short vol traders this week. Moving on to BANKNIFTY on a weekly time frame. Well, the index lost 476 points or 0.84% for the week, closing at 56,090. This looks like a minor pullback, especially considering the 2 strong green weekly candles we saw previously. Interestingly, the weekly range has been contracting week after week, dropping from last week's 2,478 points to 1,705 points this week. On a daily time frame, BANKNIFTY found resistance around the 57,500 levels. The daily candle patterns mirror those of Nifty and SENSEX, with the index closing in the red for the last 3 days of the week. One standout observation is that BANKNIFTY didn't face the same level of selling pressure as the other 2 on Friday. It fell only 0.38%, while Nifty and Sensex dropped 1.14% and 1.29% respectively. Clearly, BANKNIFTY held up much better than the broader market on Friday, showing relative strength on both daily and weekly basis. On the hourly time frame, BANKNIFTY breached the 50 EMA on Thursday but managed to close very close to it by the end of the Friday session. Again, after a cleanup trend, the question is, are we really entering a period of chopping around the EMA again? On the hourly time frame, both Nifty and BANKNIFTY currently carry a short bias, but the bias for BANKNIFTY appears weaker than that of Nifty's, given that the price remains so close to the EMA. Moving on to what to expect in the coming week. Talking about Nifty first, on the weekly charts, resistance is at 24,600, followed by 25,000 to 25,150 zone. Support remains the same as last week's at 23,550 and then further down at 22,550. On the daily time frame, immediate resistance stands at 24,600, which coincides with the 100 EMA, followed by 25,000 to 25,150 zone, consistent with the weekly view. For support, we are looking at the 23,550 and 23,450 zone, and then further down at 23,150. Based on the straddle price, the expected range for the upcoming Nifty April monthly expiry on Tuesday, April 28th, is between 24,250 to 23,550. That's a range of about 700 points, and I suspect a good portion of that risk premium is simply due to the weekend. It'll be interesting to see where the straddle premium opens on Monday, that is 1DT, and how it behaves heading into Tuesday's 0DT session. The overall bias for Nifty is sideways to bearish, especially given the back-to-back red days and the fact that daily ranges are finally starting to expand. Moving on to Sensex and what to expect in the coming week. Well, the straddle premium suggests a range of 1560 points in either direction. So this gives us a rough playing field between 78,224 and 75,104. On the weekly chart, the immediate resistance is in the 78,550 and 78,600 zone, followed by a major resistance zone between 80,650 and 81,150. On the support side, the levels remain the same as last week. We are looking at this week's low of 75,900, followed by 72,700 to 72,500 area. Switching to the daily chart, resistance is located at 79,400, followed by 80,650 and 81,150 zone. On the downside, supports are placed at 75,850 and 74,700. Just like Nifty, the overall bias for Sensex remains sideways to bearish as we head into the last week of April. Talking about Bank Nifty's expectations for the coming week, well, given that Bank Nifty has its monthly expiry this coming Tuesday on April 28th, we can check the straddle premium to gauge the expected range. It comes in at 57,026 to 55,154, which represents a range of roughly 1,875 points. On the weekly chart, support and resistance levels remain the same as last week. The 57,100 and 57,700 zone is where the resistance sits. Support is at 54,350 and then further down at 51,300. Looking at the daily time frame, the 57,500 and 57,700 zone remains the immediate resistance, followed by a major level at 60,200. On the support side, the key levels to watch are 54,350 followed by 52,800. Now, if you look at the directional bias across the board, Nifty and Sensex both currently show a negative bias in both the short term and medium term. Bank Nifty, on the other hand, shows a negative medium term bias, but its short term bias remains positive or at least neutral to sideways. MIDCAP Nifty stands out with a positive bias across both timeframes. Moving on to India VIX, our volatility index, we saw an increase of 15% and India VIX closed at 19.71. The downward move in the indexes has definitely spiked volatility. It will be interesting to see if this upward trend in VIX continues or if the VIX stabilizes as we head into the new week. And before we get into this week's sectoral performance, here's a quick update. As I had said earlier, from this week onwards, we are changing how we track and present sector performance. Instead of the traditional Nifty sectoral indexes, we'll be using the Tijori Sector Indexes (TJI) available on Tijori Finance. You can access Tijori Finance directly through your Zerodha Kite credentials. Once you are in, you will find these indexes by clicking on View Indices along with their performance and filtering options. The ones presented here are filtered on price. The main reason I prefer these over the standard Nifty sectoral indexes is granularity. The TGI framework breaks the market into 80 plus sectors, which makes it far more effective at identifying trends as they develop, rather than after they have already played out. Another important aspect, we'll be using the equal weight indexes. Market cap weighted indexes tend to be dominated by a few large stocks, which can mask the broader trend. Equal weight indexes, on the other hand, give a much cleaner picture of participation and the underlying strength within a sector. Over the next few weeks, as we keep looking at this data, this distinction will become much clearer. Now, getting to the hypothesis that I tested for this week. To start with, I looked at performance across 3 time frames: 3 month, 1 month and 1 week. And within these, I filtered for indexes that are positive over the respective time frame and then narrowed it down further to those performing above the median of all positive performers. I applied the same logic consistently across all three time frames. The idea here may seem complex, but it's quite simple. To identify sectors or indexes that are not just doing well in one isolated period like 3 months, but are showing consistent strength across medium term, short term, and the very short term horizon as well. So if a given sector or index shows up across all three filters, 3 month, 1 month, and 1 week, it's a strong signal that the trend is broad-based, persistent, and currently active. Now what you see on the screen are the TJI sectoral indexes that have shown consistent performance over the past 3 months. And what you also see is how close are they from the 52-week high. A couple of things stand out over here. Sectors like transformers and metal pipes are already trading very close to their 52-week highs, and yarn is even closer. This typically indicates that the trend is not just strong but also well established. Now what we just saw was the medium term view. Now I wanted to look at the more near-term view again. So I have further refined this by applying the same filters on just 1 month and 1 week time frames. The idea is to move from the 3-month consistency to a shorter look back to identify sectors that are showing recent momentum over the past month and week. Now this approach, I think, helps us identify sectors where the trend is not only intact but also currently active and maybe accelerating. Now compared to the 3-month filter, this filter allows 3 new sectors, which are home finance, batteries, and FMCG. But if you look at it, none of them are as close to the 52-week high as the others. But if you want to go beyond and nerd it out, there's another way of slicing and looking at this data. And that means ignoring the past 1 week's performance altogether and looking only at 1 month and 3 month sectors. So what you see over here are those sectors. The idea is not to penalize these sectors because they underperformed last 1 week, but they still hold promise on a 1 month and 3 month time frame. So in short, if you are looking at stock picking based on these indexes, all that you have to do is double click on these indexes and look for stocks within these indexes which are contributing and which are strong. Now when selecting a stock, you would have to have extra filters like volume and all of that. I'm not going into those details right now. But if you really look at it, irrespective of the markets being weak, some of these sectors are really showing some solid strength, and I hope that helps. Moving on to commodities, well, if you remember last week I spoke about gold versus Nifty correlation changing to positive for a while now, and that's quite evident this week. All precious metals are down. Gold is down 1.47%, silver is down 4.96%, copper is flat, crude has spiked a whopping 17%, and natural gas seems to be on a decline. There's another thing that I've noticed, and that is copper prices do seem to correlate with businesses or stocks which have copper exposure, both mining and product companies, and that's something worth exploring. So yeah, that's pretty much in commodities this week. So in summary, after a strong 2-week recovery, the markets hit a speed bump this week as all major indexes finished in the red. While the broader month-to-date return stays positive, the recent price action suggests a pause in the previous uptrend, with the indexes giving back some ground. Technically, on a short time frame, the environment has shifted. Nifty and SENSEX have slipped below their key moving averages, turning their short-term bias to defensive. In contrast, BANKNIFTY and MIDCAP showed notable resilience, holding up much better than the benchmark indexes and maintaining a relatively stronger posture. Volatility made a noticeable comeback after a period of calm in the past 2 weeks. The downward move in the indexes in the latter half of the week seems to have caused a spike in the VIX, reflecting in the wider daily trading ranges. Now, this expansion in volatility may mean that the easy directional move days are over and we may be transitioning into a more sideways to bearish environment. Let's see how that plays out. Sectorally, the strength remains concentrated in very specific niches. While the main indexes struggled, there are areas like transformers and metal pipes which continue to trade near their all-time highs, showing that the underlying momentum is still active in certain pockets of the market despite the broader cooling off. Now, moving on to what caught my attention this week, well, I've got two interesting recommendations for you this week. One to read and one to listen to. Now, if you followed the channel, you know I'm a big fan of passive investing, especially index funds. So the first recommendation is a research piece by the Vanguard Group on the 50-year evolution of the index fund. It traces the journey from what was once dismissed as Bogle's folly, all the way to a strategy that now underpins a vast majority of retirement portfolios, reinforcing a simple idea. Owning the market often beats trying to outsmart it. It's a thoughtful, data-backed read, definitely worth your time. A quick plug here. I spoke about Bogle's Folly in episode 3 of The Long and Short. If you haven't watched it yet, you may want to check it out. The second recommendation this week is a podcast episode number 152 of the Top Traders Unplugged, featuring the legendary Toby Crable. If you are a systematic trader, this is a must listen. He talks about how the opening range breakout has evolved in today's 24-hour markets, especially in the US, and why execution has now become the real edge. And yes, another small plug, I've spoken about Toby and ORB in episode 22 of The Long and Short as well. As always, you'll find all the links in the show notes. Now over to the events to factor in for the coming week. The next week is a heavy one for expiries. On Tuesday, April 28th, we have the monthly expiries for NIFTY, BANKNIFTY and MIDCAP NIFTY, all falling on the same day. Following that, SENSEX and BankX monthly expiries are on Thursday, 30th April. Though, let's be honest, I really don't know who trades BankX in India. There is a major global trigger to watch out for, and that is the Fed interest rate decision on Wednesday, April 29th at 11:30 p.m. This lands right before a SENSEX monthly expiry, so expect some opening volatility on Thursday. Also, keep in mind that May 1st is a holiday for Maharashtra Day. That gives us a long weekend from the 1st to the 3rd, so make sure to plan your positions and your margin requirements accordingly. With that, we wrap up this week's weekly market metrics. If you find the series useful, don't forget to subscribe to the channel, and yes, do share it with your friends. Until then, stay curious, stay steady, and enjoy your long weekend.